If Trump takes over the Fed, will inflation get even worse, or is the Fed the heroic defender of hard money it claims? Last week, Donald Trump fired Fed member Lisa Cook for alleged mortgage fraud. The first time in the Fed's 112-year existence a member has been fired. Cook apparently has zero expertise in monetary policy. Her academic career consists of cooking data to claim racism. Still, she's hired a lawyer and is suing to keep her job, so depending how these Supremes swing, she could stick around. Nonetheless, our mainstream Keynesian oligarchy is in full panic mode at the prospect of the Fed coming under control of the elected president instead of the unelected banker junta. Voters running countries. To hear them tell it, we're going straight to Weimar, wheelbarrows of money and all. Now, to be fair, we are going to Weimar anyway since Congress spends like a crackhead with $1 trillion visa, but the Keynesians claim that it will go faster once voters get a hold of the Fed. Now, this debate's been around for decades, with people like Murray Rothbard and Ron Paul arguing Fed independence is a myth, propaganda for an organization that will always serve the dark alliance of government and banks it was built to serve, while acting as an engineered scapegoat to insulate elected representatives from voters. It's actually worse. I tallied up monetary policy under Democrat and Republican presidents and found Democrats get much lower rates. They get the cheap money boom, while Republicans get recession-inducing rates, in case you wonder about those charts showing the economy does better under Democrats. Nonetheless, Keynesian professors and financial journalists argue voters would make it even worse because they'll demand easy money booms that inevitably cause inflation. So we just had a fantastic natural experiment from Trump's firing of Cook in the form of bond yields, which tell us what markets, not pundits, think will happen to inflation. So Trump floated firing Cook Friday at 10 a.m. on the 22nd, saying, quote, "I'll fire her if she doesn't resign." The comments immediately sent two-year bond yields plunging, meaning markets expect lower short-term rates. This is what you'd expect since Trump's been pretty clear that he wants rate cuts to goose the economy. What was interesting is yields also plunged on both the 10-year and the 30-year, which are key measures of future inflation. As in, markets think inflation will be lower if Trump takes over the Fed. In fact, the 10-year dropped almost 10 basis points in 90 minutes, which is close to what it normally moves in a month. In other words, just taking the data, markets think presidential control of the Fed reduces long-term inflation. So if I had to guess, what's happening here is the Fed already prints as much inflation as it can get away with, what I call the pitchfork standard, as in voter anger at high inflation or low jobs. But greater presidential control reduces the other part of Fed inflation, the trillions quietly flooded out to banks in so-called quantitative easing. So rates don't change, but the automatic bailouts shrink. So what's next? Brought to you by I Trust Capital. Ideally, Trump can break the Fed and let the economy run itself like Andrew Jackson did when he got rid of the central bank. But the next best thing is break the economic oligarchy and hand control and accountability back to the people. Read the rest with charts and all the gory details at profsanos.com. Okay, we'll be watching. See you next time.